Imagine spotting one of the biggest market moves before the world notices it. That's exactly what market analyst Michael Oliver claims happened with gold years ago, and now he believes silver is steady. Up for a similar explosive breakout back in the early 2000s, when gold was trading near $400 per ounce, most experts ignored it. Inflation looked under control, central banks weren't panicking, and mainstream analysts believed gold had little upside left. But Michael Oliver saw something completely different. He wasn't focused on news headlines or economic predictions. Instead, he studied what he calls structural momentum, a long-term shift in market behavior that can signal a major repricing event before prices fully explode. And according to him, gold had already entered a new phase. Most investors waited for confirmation. They waited for safer entry points, pullbacks, or stronger headlines. But while they waited, gold surged from around $400 to nearly $1,900. Now Oliver says silver is showing the same signals, except this time the setup may be even more aggressive. What is structural momentum? Structural momentum is a market condition where long-term momentum breaks above historical resistance levels, signaling that an asset may be entering an entirely new pricing structure. In simple words, instead of moving inside its normal range, the asset begins behaving like it's in a completely different market cycle. Michael Oliver's analysis focuses less on daily prices and more on the 12-month rate of change in price movement. When this long-term momentum breaks major resistance, he believes it often leads to powerful and sustained trends. Why this matters for silver? According to Oliver, silver has recently broken above a momentum resistance level that had contained it for more than a decade, 4 years. Silver repeatedly failed whenever momentum approached this zone, but now the market appears to have pushed through it and remained above it. That's important because, historically, these types of momentum breaks have preceded major rallies. Oliver argues that once a structural break happens, markets usually don't move slowly. Pullbacks become limited. Repricing can happen much faster than expected. Traders waiting for perfect entries often miss the largest gains. This is why he says the biggest risk right now may not be buying too early, but waiting too long. Example: gold's historic move. One of the most famous examples of Oliver's methodology was gold in the early 2000s. The situation: gold traded near $400. Most analysts remain bearish. Investors wanted more confirmation before buying. Oliver's signal: his momentum analysis showed gold had broken a long-term structural resistance level. What happened next? Gold eventually climbed from roughly $400 gives $1,900. Many investors still made money after entering later, but those who waited for full confirmation missed a massive portion of the move. Oliver believes silver could now be entering a similar phase. Why waiting can become dangerous in normal markets. Waiting for confirmation is considered smart risk management, but during structural breakouts, the opposite can happen. Here's why. Early in the breakout, prices are still relatively low. As confirmation grows, prices rise rapidly. By the time everyone agrees the trend is real, much of the opportunity is already gone. This creates what traders call the confirmation trap. The market keeps moving higher while cautious investors keep waiting for the perfect entry that may never come. Silver's current situation: Oliver says silver's current structure is even more compressed than gold's earlier breakout. For over a decade, silver formed lower highs and higher lows. Momentum stayed trapped inside a tightening range. Pressure continued building. Now that pressure may finally be releasing. According to the analysis, silver already moved significantly higher in a short period. Momentum remains strong. Volume is expanding. Other hard assets like gold and mining stocks are also strengthening. These are all signs that the broader precious metals sector may be entering a larger repricing phase. 5 key signals traders are watching. 1. Annual momentum: if silver's 12-month momentum stays above its breakout level, The structural trend remains active. 2. Quarterly momentum accelerating short-term momentum suggests the move may still be in its early or middle stages. 3. Volume growth. Rising prices with rising volume usually indicate broader market participation. 4. Confirmation from other assets. Gold, platinum, and mining stocks strengthening together can support the silver thesis. 5. Market sentiment. When prices rise while skepticism remains high, it often means the trend is still early. Ironically, when everyone becomes extremely bullish, the move may already be nearing maturity. Feedback and final thoughts. Mitchell Oliver's methodology has attracted attention because several of his past momentum calls aligned with major market moves. However, no strategy guarantees future results. Important perspective. Structural momentum analysis is one approach among many. Markets can remain volatile and unpredictable. Even strong trends experience corrections. Risk management always matters. Still, the core message from Oliver's silver thesis is clear. The market may already be transitioning into a new structure, and investors waiting for total certainty could end up reacting after most of the move has already happened. Whether silver ultimately reaches the targets bulls expect or not, one thing is certain. In fast-moving markets, timing often matters just as much as being correct, and according to this analysis, the clock may already be ticking.